Damon Varial here from stockbarometer.com and damonvarial.com. Today we are going to use a very simple analogy to understand exactly what stock options are. Now this is a question I get a lot from traders who are both new and who've been in the field for a while. The question is, how the hell do I understand these stock options? What is an option? I understand stock, I just don't get options. Stock is easy. I buy a portion of the company. If the company's value goes up, then my stock goes up. Likewise, if it goes down, then my stock price goes down. But options seem like an entirely different beast. In fact, they're quite easy to understand. I'm going to give you a very easy explanation of what a stock option is, and I'm going to use the real definition, which is really it's just a contract. But I'm going to use an analogy with a contract to show you how easy it is to understand what stock options are, regardless if we're talking about put options or call options, buying options or selling options. Those are really your only four choices of options. So if you can understand those four ideas, then you've got stock options under control. You've got the idea, and then you can actually integrate that into your trading toolbox. Options are super powerful. If you're not using them in your own swing trading or even position trading toolbox, then you're missing out on a lot of profit, a lot of risk protection, and many other opportunities. With options, for example, you can actually make profit if a stock starts trailing sideways. The stock doesn't have to go up or down to make money on option. You have many ways of doing it, so I hope you understand how to use options. If you don't, you are pretty much stuck with stock or with futures. So please pay attention here. It's a very easy explanation, and after I explain this, I'm sure you understand options at least 99% better than you did before. Okay? So let's start out with an example. Today's temperature is at 4:30 p.m. Today's temperature is 21 degrees. If this is so, and let's say it's winter, or let's say for whatever reason, you believe that the temperature tomorrow is going to be higher. If you believe that, I'm going to offer you this contract between you and me, just you and me. The contract is this. You think that the temperature tomorrow is going to be above 21 degrees. I don't think so. I think it's going to stay the same, or I think it's going to fall. Because you are quite confident that the temperature tomorrow is going to be above 21 degrees, talking about Celsius here, you and I signed the following contract. And it's a contract that I sell to you. So what I say is, if you pay me right now, I'm going to sign this contract with you that gives you quite a bit of profitability on your belief that the temperature tomorrow is going to be higher. So we're going to compare the temperature today at 4:30 p.m. to the temperature tomorrow at 4:30 p.m. and we're going to figure out if it's higher or lower. And if it's higher, you're going to profit. If it's lower, well, you're not going to profit, but you're not going to really lose money anyway, because all we're doing is trading a contract. So here's the price of the contract. I'm going to sell it to you for 50 bucks. You're going to give me 50 bucks. I'm going to write my name on this contract. You're going to write your name on this contract, and the contract says the following. For every 1 degree higher the temperature is tomorrow at 4:30 p.m., I'm going to pay you $100. So if the temperature tomorrow, remember today's temperature is 21. If the temperature tomorrow is 22, I'm going to give you 100 bucks. You spent 50 bucks on the contract. You got 100 bucks from me. I lost 50 bucks. You got 50 bucks. Likewise, if it goes up even higher, I owe you a lot more money. So for me, selling the contract is a pretty big risk. For you, buying the contract is not a very big risk. That's called a call option. The call option says you have the right to buy stock from me at a certain price. Don't worry about that definition. Just think of it as an idea in which you make money if the weather goes up, and you've already bought the contract, so you don't really lose any money if the weather goes down. You've already paid me for that right. So tomorrow's temperature, let's say, is 23 degrees. Now, how much money have you made? 200 bucks. And for the temperature, well, there's going to be a limit for the temperature. But what we're really doing when we're playing options is we're looking at the stock price. The stock price could go up, it could go down. It's pretty similar to temperature, right? The difference, though, in stock is that theoretically, a stock price can jump up super high from like 21 degrees to 100 degrees. For example, a company finds a cure for cancer. Now, you bought this really cheap contract from me, and now I owe you tons of money because the stock price went from $1 to $200. That's the idea. So, like, every degree it goes up, usually every dollar it goes up, you will make $100 from a call option. That is the idea of a call option. The put option is simply the opposite of the call option. If, for example, you believe that the temperature is going to go down, then you buy the put option. It says, for every 1 degree downward the temperature goes, I owe you $100. Same idea, except instead of temperature, we're actually talking about stock. So those are the options, the only really two options you need to understand, because they're the only two options. You got a call option, you make money if the stock goes up. Put option, you make money if the stock goes down. Now, here's a question I was asked on the Trade to Win forums. Is selling a call option the same as buying a put option? The answer to that is no. Selling a call option is simply you and I trading places. So instead of you buying the contract from me, I'm actually paying you for the contract. Anybody can write this contract. So you can just, if you wanted to make $1 million today, you just write a bunch of these contracts, sell them to a bunch of people. You got $1 million. Of course, tomorrow when we check the temperature, you might be homeless, but that's the point. The point is, selling the option is the same as selling the call contract or selling the put contract is the same as writing your name on the contract and giving me the right to take money from you if my prediction about the stock or the weather or the temperature is correct. In general, if you are new to options, I don't recommend you sell options. I recommend you just buy calls and puts. You look at the stock, you think it's going to go up, you buy a call. You think it's going to go down, you buy a put. That's it. Selling the option is simply the opposite position. You and I switch places. That's all. So selling a call option is not the same as buying a put option. Though if you are selling a call option, you are assuming that the price of the stock is going to stay the same or go down. So the mindset behind it is correct, but the actual action is not the same. Alright, so that's it. I hope that made options a lot clearer. It really is not a hard concept to understand. This video is probably like 5 minutes, so I hope in 5 minutes you can get that idea. If you want to learn how to trade options and make profits via trading options after a price gap, please go to damonvero.com. You will see a link. You will see a box in which you put your email address. You just put that in there. I will send you a free guide on trading gaps and using options. Thank you.